In this video, we're going to talk about why venture capital investments in electric vehicle startups dropped in 2023. In recent years, the electric vehicle (EV) industry has been a hotbed for venture capital (VC) investments, driven by the global push for sustainable transportation solutions and the promising growth potential of EV startups. However, 2023 witnessed a noticeable decline in venture capital investments in this sector. This drop can be attributed to a combination of economic, market, and industry-specific factors. This comprehensive analysis explores the reasons behind this trend, the impact on the EV market, and potential future outlooks. Economic uncertainty and market conditions. One of the primary reasons for the decline in venture capital investments in EV startups in 2023 was the broader economic uncertainty. Global economic conditions have been affected by various factors, including inflation, rising interest rates, and geopolitical tensions. These factors have created a risk-averse environment, making venture capitalists more cautious about investing in high-risk sectors like EV startups. Inflation and rising interest rates. Inflation has been a significant concern globally, leading to increased costs for raw materials and manufacturing. Higher inflation rates erode profit margins, making it more challenging for startups to achieve profitability. Additionally, central banks worldwide have raised interest rates to combat inflation, increasing the cost of borrowing. For capital-intensive industries like EVs, higher borrowing costs can deter investment as the potential returns may not justify the increased financial risks. Geopolitical tensions. Geopolitical tensions, particularly those involving major economies, have also contributed to economic instability. Conflicts, trade wars, and sanctions can disrupt supply chains, increase costs, and create market volatility. Such an environment makes venture capitalists wary of investing in sectors that are heavily reliant on global supply chains and international cooperation, such as the EV industry. Market saturation and competition. The EV market has seen a proliferation of startups in recent years, leading to increased competition. While this has driven innovation, it has also created a saturated market where it is harder for new entrants to differentiate themselves. Venture capitalists are increasingly selective, preferring to invest in established players or those with a unique value proposition. The sheer number of EV startups vying for investment has made it difficult for many to secure the necessary funding. Technological challenges and delays. Technological innovation is crucial for the success of EV startups, but it also comes with significant challenges. Developing new battery technologies, improving range and efficiency, and building reliable autonomous driving systems require substantial investment and time. Many startups face delays and technical difficulties, which can deter venture capital investment. Investors are hesitant to fund projects with uncertain timelines and high technical risks. Supply chain issues. The global supply chain disruptions that began during the COVID-19 pandemic have continued to affect the EV industry. Shortages of critical components, such as semiconductors and batteries, have slowed down production and increased costs. These supply chain issues have made it harder for EV startups to scale their operations, making them less attractive to venture capitalists who are looking for high-growth opportunities. Regulatory and policy changes. Government policies and regulations play a significant role in the EV market. While many countries are committed to reducing carbon emissions and promoting sustainable transportation, regulatory changes can create uncertainty. In 2023, some regions experienced shifts in policies, such as reduced subsidies for EV purchases or stricter environmental regulations. These changes can affect the market dynamics and profitability of EV startups, making them less appealing to investors. Investor sentiment and market corrections. The venture capital landscape is influenced by broader market trends and investor sentiment. In 2023, there was a general market correction in the technology and startup sectors, following a period of exuberant valuations and investments. This correction led to a more cautious approach among venture capitalists, who became more discerning about where to allocate their funds. The EV sector, despite its potential, was not immune to this shift in sentiment. Case studies of EV startups. To illustrate the impact of these factors, we can look at specific case studies of EV startups that struggled to secure funding in 2023. For example, several promising companies face significant delays in their production schedules due to supply chain issues, leading to increased costs and missed market opportunities. These challenges made it difficult for them to attract venture capital, as investors were wary of the high risks involved. Impact on the EV market. The decline in venture capital investments in 2023 has significant implications for the EV market. Many startups rely heavily on VC funding to develop their technologies, scale production, and bring their products to market. Without sufficient investment, these companies may struggle to survive, slowing down the overall pace of innovation in the EV sector. This could impact the broader goals of reducing carbon emissions and promoting sustainable transportation. Potential future outlooks. While 2023 was a challenging year for venture capital investments in EV startups, the long-term outlook for the sector remains positive. Several trends and developments could reignite investor interest in the coming years. Technological breakthroughs. Continued advancements in battery technology, autonomous driving, and renewable energy integration could create new opportunities for EV startups. Technological breakthroughs that address current challenges, such as range limitations and charging infrastructure, can attract renewed venture capital interest. Policy support and incentives. Governments worldwide are likely to continue supporting the transition to electric vehicles as part of their climate goals. Enhanced subsidies, tax incentives, and investments in charging infrastructure can create a more favorable environment for EV startups, making them more attractive to investors. Strategic partnerships and mergers. EV startups can explore strategic partnerships and mergers to strengthen their market position and secure funding. Collaborations with established automakers, technology companies, and energy providers can provide the necessary resources and expertise to overcome challenges and drive growth. In conclusion, the decline in venture capital investments in electric vehicle startups in 2023 can be attributed to a combination of economic uncertainty, market saturation, technological challenges, supply chain issues, and shifts in investor sentiment. While these factors have created a more cautious investment environment, the long-term prospects for the EV market remain positive. Continued technological advancements, supportive government policies, and strategic collaborations can help revive venture capital interest and drive the growth of the EV sector in the coming years. What do you think of our video? Let me know in the comments section below. If you enjoyed this video, make sure to hit that like button. Also, subscribe to our channel before you go. Thank you for watching.